Yo, mic check, ladies and gentlemen. Sorry for the delay. I am slightly a bit disorientated right now, straight from supper. Yeah, haven't done a live session in a very long time. I do apologize, but it looks like the Fed fund rate is out. Can I just get a mic check? Do I have my live stream on? What's going on? I can't even find my mic stand. Imagine I've got like an incense box holding my microphone. So yeah, I'm quite ill prepared for this. But yeah, can someone just confirm that they can hear me on the live? I would absolutely appreciate that. I would absolutely appreciate that, and then we can get going, right? But what we have is another 75 basis point rate hike. Fed raises interest rates by another 3/4 year. And kind of like that's what the market's kind of like it based in, right? So I would appreciate some help there. Can you hear me? I literally have my mic on top of a cardboard box right now. My mic stand is in my other work office in the house, and I was running 15 minutes late, so I just thought, let me just start. Can someone just confirm? Please confirm. I beg you, please, so that I don't have to. Yes, we can. Loud and clear. All right, I appreciate that. Thank you. All right, cool, guys. So let's just get cracking, man. Hope you guys are doing well. It's been a minute. It's been a considerable minute. I have my just 2 seconds while I organize myself. I've got my working tool camera. It's all good. Minute. I have my just 2 seconds. Sorry, got kill the feedback. Got missed on NAS H4 supply. Jeez, okay, let's see what's going on in the markets, man. Yeah, man, I think markets would be a little bit. I mean, 81%, by the way, were priced in. 81% of market participants believe we're going to get a 75 basis rate hike, right? So it's just kind of like the type of pain that we're in and what to expect, etc., etc. But for the most part, the fear was the Fed would give us 100 basis point, and the reasoning for that for me would be because the Fed wants to gain the confidence of market participants again that they're in control of this inflation situation, which we know they haven't been, right? They haven't been all year, and we've kind of like mapped that out, right? But there we go. In front of you there on the screen should be, and let me just remove my whole setup because yeah, there we go. Right. So in front of you there, you can see it for yourself. Fed's fund rate expectation was 3.25%. We are coming from at 2.50%. So if you add 75 basis point, you get what we got today. And that's really what is expected, right? So you'll see here on the articles, which is kind of like where I ran to real quick, just a confirmation, right? So what is this? Well, this is confirmation that we're still on the right track, baby. Bears hold. Bears are strong. Right. Now, in my general expectation, and maybe tomorrow I'll do a separate video around this stuff, right? The real thing today isn't the interest rates. We know about this. We know things are bad. The real issue is fundamentally around the special economic projections report, which I would normally break down within the 30 minutes. But if you've seen my live streams before on the FOMC, between 8 p.m. and 8:30, I'll do, if they are out, I'll quickly break down the numbers, the expectations, and then what Powell is released. So they are out, right now, but there's just not enough time. There's really honestly just not enough time to do that. And the reason for that is because I'm late, and I do apologize. And so I might have to come back and do a new video around this, right? But if we look at the special economic projections, and I see if I can pull them out here in front of you while we wait for Powell to get ready, right? What is generally always interesting about them is how the Fed thinks, right? So maybe if you've been following my work and you know what I'm doing, you just come into Forex Factory, Fed's fund rate, and you just click here for the latest release, and this thing will pop up here, all right? A little boy needs to go to sleep, out here playing video games, right? But anyways, it's slowing down my internet, right? So this will pop out, and then we're going to look at this new September Fed fund meeting, and I'll go PDF and read it, right? Because in there, I'm going to talk to you guys real quick off the cuff about a couple of things that I think might be actually important to consider. Right, summary of economic projections. Now, if I had time, I'd go through this properly. I don't have time, so I really won't do a rush job. And the reason for that is If one is to look at these numbers, it's my first time looking at them. You can see, I'm just coming here real quick, right? So originally, believe it or not, it's bad, guys. This is bad. It's bad and it's good, right? So the Fed funds rate is now at 4.4. This is the projection for the end of the year. Before that, it was at 3.8. I want to say that again. So this is not looking good, right? June projection has moved to 3.4. So we'll see how that is. So I mean, I would anticipate that, markets are going to bleed out right now. If you're a 365 trader or you come to the war rooms, this is what we wanted. This is it. I mean, you literally should be in one simple cell. Like my scenario analysis videos, guys, I worked so hard on that stuff. I'm coming back to the day series. I hate doing stuff in the middle of the week. It's kind of like an OCD thing. But maybe tomorrow I'll drop the next video that I promised I'll drop. I have not day traded, by the way, ever since my last one, because day trading requires time for you to sit down and day trade. And I'm doing multiple workshops. I've been in and out. We got back home. I was home on, I don't know, Tuesday, whenever. I came back on Tuesday, and I leave again tomorrow, but I'll be back again over the weekend. So day trading requires that type of focus to day trade, but you should at least still be holding this beautiful entry, and you can see over the course of days, weeks, from CPI data to release, markets try to retrace. If you draw your Fibonacci, this is a PCP area. I found amazing public lectures that I did 2 years ago on all these things, Fibonacci tools, blah, blah, blah. And if you draw a Fibonacci from the swing point here to the swing low point there, you would have known where to move. Remember, I told you guys, lock profits. I didn't say close. If you want to close, sure, it's up to you. But I said lock profits on a 15-minute supply somewhere up here at that golden ratio area. And markets went all the way back to this PCP, and they continue to drop. I'm telling you now, the reason why markets are going to continue to see pain is not necessarily about the Fed fund rate, but because the economic projections of what Powell is about to say in the press conference, right? He's about to really break down this document in the answers. And I will come back to this document, sometime during the week. I promise I will, and just break down all these numbers. Remember, this is the same person who's like, nah, GDP is fine, not in a recession. Well, let's see their economic projections. I'll break this stuff down when there's time. But the bigger point is markets now have that unrelenting double, triple confirmation that things are not good. And if I was based in the United States and my only hustle was shares, yeah, I would be in pain. I would be crying. But as traders, and this channel is predominantly for traders, although I do encourage people to continuously invest, right? As traders, we have been very clear that we're in a bear market. Bear. My latest war room that dropped 48 hours ago, make sure you watch it, because I've marked out a lot of these setups, right? So if you go to I see, Mr. Lord Forex missed an entry on the H4 supply on Nasdaq, right? This is the Nasdaq bleeding out right now in real time. Let's just quickly go to H4. Just want to see which one it's talking about. Right, so this is cool. So yeah, okay, fine. And if you come to the daily time frame, because I mark this stuff out for you always on daily, because I have a preference to catch some swing trades, right? This is literally what I did in the war room that dropped maybe 3 days ago, right? I literally say, price is going to have to come back to this area. And I say to you, it depends on how Bitcoin reacts to price over the weekend, right? I was very clear about that. Over the weekend, if Bitcoin, kind of like survives this area here, then you can expect the markets to also survive it, like to keep dropping. And that's what happened. There was contact. I know I got triggered, and now we're just waiting to see. Now, notoriously, please note, Powell has generally 9, 10, out of times, whenever there's this FOMC meetings, there's always a rally during the meeting, right? There's literally always a rally. My little girl is broken into the room, so you'll hear weird noises, just ignore her. It's okay, right? So there's always fundamentally a continuation of upward movement as Powell speaks, right? And so that's what we're going to be looking for today, in this particular war room. We need to actually see a couple of levels on the smaller time frames and the higher time frames happen. So for example, Nasdaq, the area of 12,200 is of interest, right? While Powell speaks, because Powell has a routine tendency during the press conference to continuously all the time talk markets up while crushing them down, right? And a lot of people get stuck in that, method. They get stuck in that continuous flow of, well, is it a bull rally? Is it a recovery? It's going to say crazy things about the job markets and all that kind of stuff, which I'm sure you guys know of. So watch out for this level here, 12,200. If this area breaks on the NASDAQ, then we can expect a day or two for a relief rally for the markets. But then once that gets cleared out, then there's no point in trying to short the market until it gets to these higher points here, right? So I hope my chart is clear. Let me just see how much real estate on the screen there, and I'll also remove this for you. I really want you to get it right. I generally am not a buyer, haven't been. I honestly have not been a buyer in this market all year round. And so what I'm doing is I'm going to be holding this. You should by now have already broken even, right? This is like still that CPI drop, or this you should still be holding this, right? But issue there on. What I want to do is just break even on this right now, so that this is very loose to kind of like run, the way it needs to run, and then take profits if I feel like price is going to stop me out at zero. But for the most part, with the 75 basis point confirmed rate hike that just happened right now, number one. Number two, economic projections looking this bad, right, guys? All right. So let me show you why they look bad. So let's quickly reopen this link again. I've got the FOMC press conference here by the side. We're gonna watch it together. I'm gonna pause. If you're new to how I do these things, I will pause if I feel like there's something I've never explained before in terms of the jargon, the language, and all that kind of stuff that they use. I'll make sure that I break it down. But I just want to pull out the previous economic report. So this is the last time we're together, all right? This was in the July, the FOMC on July, all right? And you can see the minutes were then later released again on the 17th of August, right? The final projections. I want you to look at the difference in what we have here. Come on, man, what's going on? I don't want the statement. I'd like to see the minutes, right? I want you to kind of like compare the FOMC's thinking all the way in June, July. No, these are the minutes. Oh no, we haven't had summary. We did not get a summary of economic projections in June. I apologize. Let's see projection materials. It's been a while actually since I did this. There we go. Projection materials. So the last ones were in March. The first time there was a Fed rate cut, right? And there's a reason why, because they actually go by a quarter and they skip a quarter, something weird like that. So you can see for yourself, the last Fed meeting was on March, the very first one of the year, and that's when we got projection materials. And then let's look at the one in June. I'm all over the place. I apologize. So let's look at the June one, because that's the latest one, right? I'm sure they changed their minds in March, but I want you to see how they thought things were going to end at the end of the year in June, and how things have panned out right now. So this is the latest one. We'll double check that, but this is June. So this is why I say 3,4, right? You see earlier on, they believe that the Fed's fund rate by the end of 2022, I'm making this stuff up, man. It's like, yeah, sure, markets are tough for retail traders, absolutely. But there are some retail traders doing better than institutions. Don't ever be fooled. Inside institutions are individuals who are prone to learn to mastery, and the difference between them and you is mastery, time, and capital, right? You've got time to learn this stuff properly. You can master it. I'm here for you to do that. You can grow your capital. You'll never have capital of an institution, but you can definitely create a life. Now check this out. These guys believed, right, at 34%, that would be the Fed's rate hike. Okay, 3.4%. Look at where we are today. Today, we're now at 3.25. And it's October. All right. Now, look at the latest economic projections. They're now saying, yeah, look, dear markets, well, we're looking at about 4.4% by the end of 2022. Well, what does this mean? Ladies and gentlemen, it means for us to get to 4.4%, a currency at 3.5%, there is going to be several priced in rate hikes. So you can expect more pain. All right. This is literally my interpretation right now. David says, hey, Lee, but about NASDAQ, it seems to me It's about to get to a daily demand inside a weekly side. What's your prediction? Hey, David, I can have a look, brother, but I don't care. I don't care about NASDAQ touching any demands. If every time NASDAQ hits a demand, it goes without me. I never, I mean, sometimes I'll play around at 0.01 because I'm bored and I'm watching markets move and I want to see if I can catch a fall. But honestly speaking, David, I have no interest in any single demand that risky assets are going to make. All demands are expected to break despite the headlines, right? So there's this demand here, there's this area here that you might, I'm not so sure which one. David, can you just quickly let me know which one you're referring to? So I'll write here one. It's so nice to have people live. I've been just doing like pre-recordings by myself, and just, putting it out there. So it's nice to get live questions. We've got about 2 minutes before Powell talks, David. So if you can just help me out as quickly as possible, right? I'm just going to put two somewhere there. Which one are you talking about? One or two, David? Let us know, one or two, and then I'll just quickly do a quick analysis on NASDAQ for you. So I'm just saying routinely somewhere here, one or two. And then if David doesn't answer in 10, 30 seconds, then, I'll just move on to kind of like just breaking down, all these demands, right? But my take on NASDAQ is it doesn't matter, right? All these demands in the past have just given birth to perfect sales, right? Perfect sale opportunities, right? Tomorrow, maybe I'll drop an old video that I never put up on my YouTube on the use of Fibonacci. Why? Because it's absolutely crucial. So this is how I've been, trail stopping some of my major swings, right? Swing high to swing low. So here's the first, and maybe let's move away from this chart. David is saying one. Okay, so before I do that, let's quickly answer David correctly, right? David, I don't even like demand number one, although it's a valid demand. I don't like it simply because, it was highlighted like this, when I came back from being sick as hell. I was away for a while, and I told people to watch out for this demand, that it was going to rock their world. And it certainly did. This was the beautiful demand that was going to change character, blah, blah, blah. But if you draw this demand out like this, David, you realize that, number one, fair play, it was very strong, right, and led a big rally. Now markets are coming to it. It could work. But the question now is, you now have all the information in front of you. You know that, markets are pretty much screwed or are due for more pain. But you'd buy to what end? That's my question. You'd buy to what end? Because buy number one at this level is to gamble, right, that this supply is going to be taken out. That's buy number one. It's possible, but it's not a high probability set up. That's it. So then the question is, well, NASDAQ, moves quite rapidly, and it's very possible. And I know a lot of you guys don't like taking daily trades on indices, fundamentally due to, it's costly, right? So you want to, narrow your areas of value down, and I respect that. But if you use a swing area like me, right, this is barely 1:2. It's actually 1:1. So the risk to reward doesn't even make sense. But let's say I was to scale down to H4 to find, a sufficient scaled back, area. I would find this demand right there, and you can see fresh touch retest, right, on this demand, and that's at about 11,1600. All right, I'm talking about the NASDAQ area to 11,1600. So if I was to take a third buy, why number three? Well, there was a fresh touch and a retest. Like, David, our rules, right? If you've done the course module one, glass effect, sensitivity of areas of value, right? So if I was to take a third buy, I am practically now full-time a retail trader. But let's say we take a third buy at 11,1600, right? That puts me now roughly at a risk to reward of 1:3. And you might think that's attractive on the H4 until you realize that, well, what happened right now with the FOMC talking right now? I mean, I don't know what's going to happen when the FOMC starts to talk, but when the rate dropped, you can see here, we moved here, right? There's a new supply right there, which again reduces how far my buy can go, unless the gamble is it's going to break through these supplies. So David, I would not at all take any of those buys. We should be live right now, folks. I got to shut up now and hear the men talk. Right. So guys, I do apologize. Let me know if you can hear Powell. Just give me a second. I've got so many things running. I'm so ill prepared for this live stream. I apologize. I apologize. David, I do hope that helped. I do hope that helped. Right. So let's see if we can get Powell now. Oh my goodness gracious. I feel like this happens to me every time I do a live stream. It is the constant. I'll rewind it a bit back. Don't worry, we won't miss a word. Just gotta get it started, right? Just gotta get it started. And the first 10 minutes of his speech are always, just same old stuff.
Sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment.
Can you guys hear him? Please confirm if you can hear that. The small part that I just played right now, just let me know if my audio is good. Because I'm running on a different thing. He's about to walk on stage, but I just want to know the small power part that I just played right now. Could you guys hear that clearly? There he is. Did you guys hear that? Thank you. Thanks, Alvin.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employee employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer run normal level. Inflation remains well above our 2% longer run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its...
Sorry, guys. I don't mean to pause, but you hear this, right? He's literally saying what I just said. Like, look, man, we project 4 whatever by the end of the year, and then next year in 2023, that's 2023 at the bottom there, still a little bit higher. So you have to kind of like start to put yourself in that mindset, all right? As a trader, it doesn't matter. We bear, right? We're very bearish, okay? But as a crypto trader, so some of you guys don't even care about shares and stocks in America, Tesla, Apple, whatever. But if you're into crypto, you have to start to consider the consistency with the amount of pain the Fed is bringing and what assets are going to happen, right? So you need to be very clear about your long-term picture if you're holding on to crypto. 1, 2, good crypto projects, right? So not everything flies. All right, so because that's what he's saying right here. He's saying, look, man, look, this year, expect pain. Next year, we might even still be, aiming it a little bit higher. but eventually we're going to get you 2 something percent. But that's in 2024. That's coming out of Powell's mouth. There are going to be many articles and many bull rallies in between that. Don't get trapped. As a trader, you do what you want. You buy or sell according to supply or demand, if that's who you are. But the long-term trend right now is downward. It's just something I want to highlight.
Longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now.
Sure.
We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Nice and short today.
Hi, Chair Powell. Thank you for taking our question. Gina Smilek from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%. And we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%.
Guys, I'm sorry. I'm so sorry, but this is crazy. Did you hear the question? I know. I mean, this is kind of like how I watch movies with my partner. She stops at everything and he gets annoyed. But this is money, right? We need to break this stuff down. She said, how will you know when to stop increasing the interest rates? Which is asking, when can we anticipate a Fed U-turn? On CNBC, the articles will be like a Fed pivot point. Most market participants thought the Fed pivot point was going to be today. You rewind 3 months back, 2 months back, June, July, everybody thought it was this meeting where we're going to get, since inflation peaked, where we're going to get inflation data that would force the Fed to U-turn. That's what she's asking. Cool question. Did you hear his answer? He's like, let me start off by saying everything that I said at Jackson Hole still stands. That is where this man said, and I made a post about it. He said, more pain to come. Like, I'm not playing. I am committed now to destroy demand until it equilibrises with supply. All right, so he just said that right now. All right, we can look at the charts as he's talking, but I assure you, there we go. Look at that resuscitation. Just remember what I say. Whenever the Fed talks, right, there's that bear rally, not bull rally, bear rally. All right, so this is going to be sold off quite hard in the next few days. But let's hear what more is being said.
To accomplish that, we think we'll need to do two things in particular to achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out, but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Mr. Chairman, with CNBC, can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time you can see pausing? Is it linear that you keep raising rates, or is there? Oh, sorry. I should know better than to not talk with my microphone.
I know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll just have to see how that goes. There is a possibility, certainly, that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly today, we've just moved, I think, probably into the very lowest level of what might be restrictive. And certainly in my view and the view of the committee, there's a ways to go.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
This is what she's asking.
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest.
Because Homie said last time in June, they still think they can do a soft landing. Homie also said last time in June that labor was very strong. In fact, labor was so strong, people like me calling for a recession were crazy, right? The last NFP, guys, I'm not making this up. The last NFP report actually showed a fracture in Powell's labor, right? If you guys focus on, probably taking time to find, right? Unemployment went up, yes. They met that job number, but unemployment went up by like 0.2%, right? Or somewhere here. So that's a very good question she's asking. But this is what she's referring to. Okay, what have I done?
Increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high. relative to the number of people looking for work, it's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. That's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. As I've said, there's no basis for complacency there. But to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say, how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, a rather increase in unemployment, and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether also do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding what the labor market is.
Nick Timmeros of the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive, and by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lengths, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know, you look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting, and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve, and I think that would be the case if you look at the numbers that we're writing down and think about. You measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time you'd see positive real rates across the yield curve, and that is also an important consideration.
Howard.
Hi,
Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on this. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases.
Right. So how do we get to this number, 4.4? That's what that guy just asked. Powell is saying we'll see, median by median. But this guy's like, look, you already have a rate for the end of the year, which is 125 basis point from where we are right now. So it's going to be another 75, 50, and 25 to get to 4.4. That's what he's asking. The answer to this question is all the markets are going to use to price what's coming next. All right. Is it going to be yes, we're going to slow down a bit, 50, then 25 by December? Or no, we might do 75 to get to this number, because there are many ways to get to 4.4. We could just do a full basis point and 25, right? So just saying, this is important now.
But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase.
It's fine.
As we approach the level that we think we need to get to, and we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive?
Sure. Thanks, Alvin. I just don't want to annoy you guys by constantly pausing, right? But basically, what we're saying there when we're talking about the core PCE and versus CPI, Powell, his actual words were inflation has not gone down. I'm bringing this up because there's always constant drama in the market on a week-to-week, on a day-to-day trade, on a data-to-data report, right? Overall, that there's this thing called a peak inflation, and then there's gradual drop of inflation. And according to the Fed, they understand it to be nothing's really happening. So we look at a CPI, which is Consumer Price Index, and I've said this before that they like to look at core PCE, which is basically CPI looks at how the consumer, right, you and me going to buy bread, are experiencing the increment of the price of the things that we're buying. That's what CPI is measured. So our rent, our gas, our fuel, all that kind of stuff. The Fed likes to look at from the manufacturer side, from the producer side, how much inflation are they spending, or is it affecting their business to procure raw materials to make that stuff? And he said, when you look at the data for core PCE, and if you think about it, right, at the end of the day, we all get finished products, right? The price of bread is a complete calculation from the farmer who made wheat, blah, 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 blah. And so all the markup of profits for different people has already been put in that one loaf of bread. But when you look at the price of the creation or the production of bread, the Fed is then able to start to trail out and map to see if price hikes are coming or going down. And he's saying, well, if you look at the numbers, it was first 4.8, then 4.5, then went back to 4.8, which again to them pretty much means it's too early, I guess, to tell that inflation is going down. And I've said this before, that 9 out of 10 times with these inflationary data, right, just to get markets pumping, what will happen is, and I was actually making notes about this before Alvin told me to finish my train of thought. But what you can always anticipate is a report will come out and say peak inflation, so don't worry, and that will start pumping money in, right, bull rally. And then the next report might even give you a confirmation of that, right? To say, oh, look, it was 9.1. This literally happened in real life. 9.1, then it was 8.5%. Then people went crazy. And then what was the projection now? The projection was going to be 8.1. And what happens is, instead of making this low, market stopped here about 8.3. And what could happen over time, right, is we could go back to this, because you really can't tame. And once inflation gets out of control in a productive economy, you are screwed left, right, and center. You are absolutely screwed left, right, and center. And it is an absolute pain to control it. And so he's simply saying, look, man, I can't even give you that type of projection to say inflation is stopping here, because this chart pattern is not yet clear. What Powell wants, and he said this many times, is this. He wants multiple reports. And I think for the Fed, multiple reports, we're looking at a 6-month span. You can see in their economic projections, even for next year, they're projecting a higher Fed rate hike, which means they want to see this. Multiple confirmations of inflation holistically going down, 8.1, even if it's dead slow, all right? If we get 8.0 in the next CPI reading, that's good for the Fed. And then 7, something, that's what they want. What they don't want are these surprises that might appear and these sharp drops, all right? So that's pretty much what my train of thought was there, buddy. Thanks for the green light there.
100 basis point increase today, and does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August.
I just say this.
I think you have to, you never want to overreact too much to any one data point.
Yeah.
So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. So that's how we think about it.
Victoria. Hi, Victoria Guida with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might
balance sheet for mortgage short securities. I said this before in the public Telegram group. I'm currently doing research around this because I saw people asked a few questions, but I'm going to say it again. There is a movie called The Big Short. That movie is a real life story. In fact, the trader in that movie is making a lot of noise right now on Twitter. All right. He just did it again. He's prepared. But granted, that guy is kind of like, he comes from a lot of money. So the way he thinks and trades, right, he takes very big risks once in a big while and he makes a lot of money. But the movie is called The Big Short. It's based on a true life thing. She's asking, what are you going to do with these mortgage securities, right? Go see what they did with them in 2007, 2008. Go see how they pampered around this issue, guys. I don't cover this stuff enough on this channel because I don't have enough data yet or according to what you guys want me to do. I know you guys like war rooms because it's just signals, but that is 1/5 of the stuff we could do on this channel. The housing crisis that is literally flirting with our global economy is coming. And if it is not tamed the same way inflation has not been tamed, expect serious pain. Start to read articles around China right now, the housing market, the Evergrande, the developers, contractors, the $7 trillion crisis. And just think about the trickle-down effect that will have. And if you can't imagine it, just come to your charts here, Euro USD, for example, go to the weekly time frame to save you a lot of time and scroll back as quickly as possible, right? All the way to 2008, 2009. And you will start to see what I'm talking about, right? The type of pain that we're about to experience in the markets is not the kind of pain that goes away quickly. It is the kind of pain that gives birth to 10-year trends, okay? Remember, as a trader, we are unbiased. We just go where the money flows. You see Euro USD, I'm on 2014. You can see that price has been gradually coming down. This downward movement didn't start out of nowhere. It starts all the way here in 2008 due to that liquidity crisis triggered by a housing crisis by these people, right? FOMC. In fact, I've got a big purple die where I write ideas of videos to do. I'm going to do a video to show you all the thousands of lies the Fed said on podiums, all the thousands of lies in the Wall Street Journal about how everything was okay before, boom, people's money disappeared. And then I say to you guys, when watching The Big Short, because most of the people I make content for and my videos are predominantly watched in Africa, right? Think very clearly about crypto and what this means for the crypto market. Like, just think about housing as an asset and think about crypto as an asset. And then think about how to make your money. Right now, as a trader, my crypto portfolio is bleeding. It is absolutely, I've never seen such pain. I was in the clear for a very long time. Why? The majority of my Bitcoin I bought long time ago, right? And not back in 2012, but back definitely 2018, 2019, I sold a bit, sold quite a bit actually, and I started to rebuild that portfolio long before COVID came in. In 2020, I went crazy, right? Because in 2020 in Bitcoin, with this perfect opportunity to get crypto, or at least a Bitcoin for as low as $3,000. Right now, the portfolio that's feeling a lot of the pain is the one that I'm creating for my kids. Because I've been buying crypto since my little girl was born in 2020. I've been buying crypto for my boy since he was born, or no, not since he was born, since about 2020, 2019, 2018. And the prices starting to really come very close to where we started buying. In fact, we're already at the November 2020 mark. So I'm starting to see red in that particular portfolio. And I'm saying to you, if you don't care about the housing crisis, because you're not invested in the housing crisis, I want you to understand the parallels, right? The impact that it's going to have on the markets, right? If this doesn't hold, which I don't think it will, why should it? Why should it? Unless if all the whales create defensive lines here, right? That's the only thing about crypto is the uncertainty part is how whales, move. But generally speaking, if you think like an institution or think like a whale, you'll know there are better, cheaper bargains all the way down here. In fact, even my 12,000 mark is heavily contested, right? My 12,000 mark is heavily contested in the sense that there's 8,000, 9,000 demands. So watch that movie, but just get this idea of housing out of your head. Think about all sorts of really big demand issues. Crypto, right? but also think about the future, how all of this is good for you. My portfolio hurts, but my trading is great. So I'm hedging myself. As my crypto portfolio falls, I am selling. I've been a seller all year on the spot market. Not selling my crypto, I'm trading sales on the spot market. That money is buying back the same assets at great discounts. Sorry, but that's important. Very important.
Your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was
Mortgages.
that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and
3 months ago, he said recession wasn't even close. He said, I don't even think jobs are doing well. Go check on his website what they've written about recession now. Yeah.
conditions in the housing market affect that decision?
I think a number of things might affect that decision. But the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment and price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us, and vice versa. The forecast that we put together, that our staff puts together, and that we put together on our own, always try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about, the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it. It's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times. But really, we're in very different situations. But I will tell you, our contact is more or less ongoing, and it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong. But there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity of all different kinds and housing price increases moving down. So we're having an effect on interest sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash, so there's good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that, and that's a good thing because that means the economy will be more resistant to a significant downturn. But of course we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now,
I don't want to keep us up all night, but I want to answer all questions. So I'm going to have to pause again. So Lord Martin first is asking, man, Euro USD, since we're close to the lowest monthly demand, what's the probability of it holding? What's the probability of that demand holding price, right? Are we going to see what happened, to GBS USD happen there, where we are selling without a monthly demand? My answer is kind of yes, probably. Right. This is still, my goodness. Okay, my kid is just destroying the internet. Right. So I'm just waiting to. I was gonna show you guys market correlations on my FX book. I know it by head, but I thought I'd show it to you. Right. But anyways, there's an 85% correlation between Euro USD, and the book is too far, and Pound USD. Right. So generally speaking, the primary market is normally Euro USD, but because we are so risk averse, so risk off, the more sensitive asset is GB USD. All right. So once again, primary market that normally leads the way is Euro USD. In fact, Euro USD was selling off 3 or 4 months ahead of Pound USD earlier on last year and this year, right? With Pound USD selling demands earlier, at the top, right? So Pound USD has cleared most of the monthly demands and is now in this range here. So this is the last major turning point demand that Pound USD has finally arrived. So we're going to see some type of buyer's reaction, right? In this zone here, there has to be. Right, your supply and demand curve will tell you that there's some old hardcore, bulls hiding out in this area. But the consistency of these risky aspects to sell off, for me, is telling. Now, to answer your question, in terms of Euro USD, and really, I'm talking from a perspective of swing trade, right? It honestly, even Pound USD, it always depends and absolutely matters where and when you enter. It always depends where and when you enter. So if the first time you're holding a swing from Euro USD is somewhere all the way down here, then just know that you are on the right path, but you're playing with fire, right? Because, the retracements are allowed to come as high. I mean, technically speaking, right now we're on supply number 11. I don't know if you guys know what I mean by that. So Euro USD, well, supply number 11 is the closest supply to the demand, right? So I'll go back to my Sasco chart where I mapped out all this stuff for you, right? So this is Euro USD on the governing time frame, right? You can see this is about to get smoked, or at least my assumption is this is what price would love to do, remove this. Like even if you pull this up on a Kinihashi candlesticks, you will not see that type of momentum confirmation to say there's an order block there, right? It's just all green, which means to me this entire imbalance could be filled this way. When I say filled, I mean these market efficiencies could literally be filled, right? So there's still a long way to go for Euro USD, number one. Number two, Euro USD, by the way, has been very faithful to our thesis right now of being bears, right? Taking out COVID demand, which was very strong, guys. The COVID demands were significant because the market literally had to print Trillions. That's why Powell is in this mess. They printed a lot of money to propel the markets up. So these demands were supposed, under normal circumstances, they were supposed to hold. That broke. A historical demand from a short crisis in the market in 2017-18 also broken, right? And now we're here. So to answer your question, man, yeah, for me, I would anticipate that USD is going to make headway down there again. Long term, I'm looking at a world where $1 to 60 cents of the euro. Right now, we're just playing around at 1:1, 1:0.98 cents in terms of the exchange rate, that is. So I still see more pain. As long as Powell is increasing the rates into the future like this, the dollar is going to be strong, the euro is going to fall. Yes, ECB hawks are coming, but yeah, let me know if that answers your question. Please don't forget to like the video, guys.
Overarching focus, and you see that I think in the SEP in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below trend growth and modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward looking and the lags in your policy are forward looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a slower, it's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this. Inflation, what we hear from people when we meet with them is that they really are suffering from inflation. And if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
How will you know, or will you know, if you've gone too far?
Hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability. And you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that high inflation will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion, and this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment. And the way we do that is by slowing the economy. Hopefully we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability. And I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Taking the question, Mr. Chairman. Edward Lawrence from Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down. And what you see in our projections today is that inflation moves down significantly over the course of next year, and then more the next year after that. And I think once you're on that path, that's a good thing, and things will start to feel better to people. They'll feel lower inflation. They'll feel the economy's improving, and also if our projections are close to right, you will see that that the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs. And we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for another long period. This era has been noted for very long expansions. We've had 3 of the 4 longest in measured history since we got inflation under control. And that's not an accident. So when inflation is low and stable, you can have these 9, 10, 11, 10-year expansions, and you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
As a follow-up, what is that economic pain in your mind? Is it job losses? Is it the higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, down the road again, and doing it at a time when actually now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises. And so we want to avoid that. We want to act aggressively now and get this job done and keep at it until it's done.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week, and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset, and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country, where famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. There are also longer run issues though with the housing market. As you know, it's difficult to find lots now close enough to cities and things like that. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
Shelter made up such a large part of this hot CPI report that we saw. Do you think that there is a lag and that we will see that come down in the coming months, or do you think that there?
Do you guys watch War Rooms? I spoke about this in the War Rooms. But anyways, check this out. I've taught this earlier on when I was looking at stuff during the year. I remember I showed you guys this chart. This is the US 10-year Treasury bonds. Whenever people talk about housing markets, but interest rates, they're talking about mortgages, right? If you're in South Africa and you are unfortunately forced to buy a house through the biggest mafia in the world, which is the banks, you're going to be charged an interest. Now, this chart here, the US Treasury chart, anything above 3% is bad, right? So, because remember, if they keep increasing rates, right, this 10-year chart is going to keep going up, which is a good indicator for more pain in the market. Now, the last time we were here, I remember we looked at the trend line that I drew, and you can see it was in 2018, the last time prices kind of peaked above 3% and then began to sharply fall. You'll note that even if I'm not trading a chart, if it's not tradable, I still read my charts in alignment with supply and demand, right? So what's happened now is ever since the Fed started going crazy, printing money in 2020, this thing was on the rise just a little bit. And then all of a sudden from last year, 2021, when there were now talks of slowing down tapering, which is the last order block right there in November 2021, the thing's been on a crazy bull run. And it's now not only crossed over that psychological 3% line, but actually, and this is literally the rate that we're looking at, right, is actually now closing bullish candlesticks and opening new ones on the other side. So this is not a good sign for the markets, right? So this is what she's saying. But yeah, I spoke about it in the previous war room. I literally spoke about the stuff in the previous war room that she's asking.
Still this imbalance that needs to be addressed.
No, I think that shelter inflation is going to remain high for some time. We're looking for it to come down, but it's not exactly clear when that will happen. So it may take some time. So I think hope for the best, plan for the worst. So I think on shelter inflation, you just got to assume that it's going to remain pretty high for a while.
Okay, we'll go to Jean for the last question.
Last question.
Hi, Jean Young with Market News. You've talked about the need to get real rates into positive territory, and you said earlier that policy is just moving into that territory now. So I'm curious, how restrictive is rates at 4.6% expected? Is that expected to be next year? How restrictive?
So I think if you look, when we get to, let's assume we do get to that level, which I think is likely. What you're going to do is you're going to adjust that for some forward-looking measure of inflation, and that could be, you pick your measure. It could be, there are all kinds of different things you could pick and you get. But what you'll get is a positive number. In all cases, you will get forward inflation expectations in the short term. I think that are going to be, assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive federal funds rate at that point, which could be 1% or so. But I mean, I don't know exactly what it would be, but it would be significantly positive when we get to that level. And let me say, we've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook and ask ourselves whether our policy is in the right place as we go. Thank you very much.
Yeah, guys, listen, man. Let me go to sleep. I'll come back and really cook for you guys. What Mans was saying. If I need to kind of like, I also sit through the document of economic projections for you guys, so that I have a clean breakdown of exactly what happened. But while I was away, I actually found an interesting PDF that I'm working through right now, and I just wanted to quickly share it with you because it's a fascinating read. It's a very short article, blah 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 blah. Right. So remember, I'm starting to teach you guys on schematics, in the day trading for schematics, right? And listen to this guy. So this is Wyckoff, right? Check the age. 1934. I just want people to stop messing with this. 1934. That's when he dies. Right, 1934, guys, for those of you who need that type of historic lecture, 1934 is Hitler. Like literally World War II is brewing in 1934. Now, this is a summary of the greats. I don't know if you guys know this, right? So when I had to do my master's in the International Federation of Technical Analysis of chart work, right, we learned about Dow and Gate and how to plot Elliott waves and all that kind of stuff. And so there's this guy called Wyckoff. Wyckoff comes from stocks. Don't worry, I've got a lot of videos that are going to roll out on this stuff, but most of you are going to see it and experience it in module 3. All right, it's not really going to be for YouTube, right, except for the basic schematics that I'll give out. But there's just an interesting quotation that I picked up over the weekend when I was away. Listen to this. This is written in 1937. In 1937, all fluctuations in the market and in all various stocks should be studied as if they're a result of one man's operations. Now, maybe I need to back up and kind of like explain what he's saying here. So he had this idea called the composite man. It's not a real person, but it's just how he approached the market. The composite man, so he proposed a heuristic device to help understand price movements, individual stocks, blah, blah, blah. Now, the composite man was basically this idea that if you look at how markets move, picture one person controlling the markets. We call that institutions, smart money. We call that banks, right? But there are many banks, and banks compete against each other. Big banks destroy small banks all the time. Right? It's not like this very unison, organized formation. Smart money is very complicated, right? You'll see in module 3. But in general, smart money, when they have their ducks in a row, move together against each other, but also against the broader market retailers for liquidity. And he said, think about it as a composite man, just one human being controlling it. It's not one, but just think about it that way. And he said all the fluctuations in the market and in all various stocks, Forex, blah, 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 should be studied as if they were a result of one man's operation. Let us call him the composite man, who in theory sits behind the scenes and manipulates the stock to your disadvantage. If you do not understand the game as he plays it, and to your great profit if you do understand it. He advised retail traders in 1930. His academy had 200,000 students learning how to trade stocks from him. Right? His autobiography is absolutely brilliant. But yeah, I'll get into that stuff later. Now, he advises retailers to try and understand the play and play the market as the composite men played it. Trade like smart money. You can see down there below. I'm telling you to join us for that reason. In fact, he said that it doesn't even matter if the market moves are real or not. It doesn't matter. It doesn't matter what anyone thinks about the market, including myself, whether it's manipulated or not. What matters is that everything is a result of actual buying and selling by the public and bona fide investors, or artificial buying and selling by large operators. It doesn't matter who's buying or selling. What you need to think about is thinking like the person who moves the markets or who thinks like the markets. And he just built on this theory. And I just kept reading this. And I was like, wow, 1934, supply and demand. Anyways, enough of this stuff, guys. I absolutely appreciate all of you. Thank you so much for your time. Thank you for, kicking it with me. Powell is not playing. We wish we had this Powell in March, by the way. If Powell had been hawkishly serious and sort of with a full basis point, the market would still have fallen the way it has now. The difference is, had they started this in March, like I said, right, and taken it seriously that they cannot control inflation, by now markets would have fallen, but there would be a real gap difference between the rate and inflation. That's my humble opinion. These guys are playing catch up as they're about to suffer employment and destroy businesses as housing, shelter stuff goes up. It's about to be a very interesting time in the markets. But yeah, shake my hand. I've got another video cooking for you guys because I didn't finish the war room asset. So I'll drop that tomorrow, fingers crossed. And then we'll go back to day trading scenario analysis. See you in the next time. Thank you so much. Something's gone wrong with my camera. Goodbye, 365. Sorry, my camera is bugging. Cheers, everybody. Good night. Don't forget to like. Don't forget to subscribe. Good night. Good night, everybody. Good night.